The following paid commercial program is brought to you by TD Wealth.
Hello and welcome to Money Talk. I'm Kim Parley. Thanks for joining us. The Bank of Canada has made it clear its fight against inflation is not over yet. The Bank of Canada unexpectedly hiked rates by 25 basis points, taking its overnight rate to 4.75%. In the statement, the central bank highlighted an economy that was stronger than expected and a labor market that remains tight. For more, we're joined by James Orlando, senior economist at TD. This was a bit of a surprise, wasn't it?
It was. No one was really expecting the Bank of Canada to be this fast with how they were going to respond to the fact that all the economic data we've gotten over 2023 has come in hotter than expected. The Bank of Canada paused back earlier in the year because they thought that the economy was going to slow. It hasn't. It's accelerated. And so now the Bank of Canada is back in hiking mode. And that's why we got the rate hike today. I
want to come back to when you just said the economy is accelerating, because that's, I think, critically important. But let's just also touch on, the Bank of Canada made its move this week unexpectedly. The Fed is on tap. What's going to happen with them? Because we were talking about earlier, they went up higher than the other central banks. Maybe they might pause now.
Yeah, so when Bank of Canada, the other central banks around the world said, we're going to take a pause earlier this year, they stopped short of where they probably needed to go with respect to how high interest rates need to get. The Federal Reserve, on the other hand, said, we're not that confident in pausing just yet. We're not confident the rates are high enough to actually slow economic growth to a level that we need. So we're going to keep going. So they got to 5.25, whereas the Bank of Canada got to 4.50. Now you're starting to see Fed members speak out saying, you know what, maybe 5.25 is enough. Maybe because look at what's happening in the United States. Mm-hmm. We got the regional bank stress. You saw how when rates got to a certain level, certain areas of the economy started to show weakening signs. So maybe the Federal Reserve is going to pause next week just to make sure that they're not going to go too far, too fast.
Okay, let's go back to the economy accelerating. Yeah. And the Bank of Canada also acknowledging that things are running hotter than expected. Yeah. Why? What and for how long?
Yeah, so when we look at all of the major indicators for Canada. You look at our gross domestic product, so how much stuff people buy. So consumers are a part of that. Consumers are spending at a rapid clip. So notwithstanding all the interest rate rises that we've had over the last year, consumers are back spending, and not just on the need to have things like grocery store items. They're buying cars. They're buying expensive things that require loans to get. So the high interest rates are not slowing consumers. And so when we look at what the reasons are, we look at incomes of consumers. So how are consumers' incomes doing? And you look at the labor market strength, the number of jobs produced every month. You look at wages rising now faster than inflation. You look at government supports. You look at even all the money that people saved during the COVID lockdowns. All of that has enabled people to keep spending, notwithstanding the high inflation, notwithstanding the high interest rates that we have right now.
Higher incomes beget spending begets more inflation,
yes,
right?
Yes.
So when does this change? That's the thing I understand. Is I know what you're saying, but at some point, something has to happen. So where's this going?
Yeah, so this is the big worry for the Bank of Canada, for all of us, is that we've made such great progress on inflation over the last several months. The reason why we made progress on inflation is because most of the inflation that we got over 2021, 2022 was stuff that was outside of Canada. It was Russia's invasion of Ukraine that impacted food prices, impacted oil prices. It was the supply chain stuff that we got during COVID that took forever to unwind. That is really solving itself in lots of ways, in the sense that prices of those externally driven factors of prices have come down. And that enabled the Bank of Canada to say, okay, we think we can pause. But when consumers go out and they spend money like they're spending right now, if you're a business and you're seeing all this demand for your stuff, and you're saying, okay, well, my workers are demanding higher wages, I'm going to raise my prices. And so the big risk right now is that we went from a supply externally driven time period of inflation to more of a domestically demand driven time period of inflation. This is what we call homegrown inflation in Canada. And this is why the Bank of Canada hiked rates, because if people keep spending, prices don't go back to to that 2% level that we're all hoping they're going to get to.
Is there not something, though, when it comes to just delayed reaction? And I was speaking with somebody earlier about, in the age of social media, everything's instant. We expect instant. So you expect rates, when you increase them, to have an instant impact. I've heard so many anecdotes, and I was sharing with you earlier, when we were talking about, someone who has a big mortgage, what they're paying per month at 4.5% now, 4.75%. I mean, these are big numbers. Is it just taking time for that to transmit to people to say, oh, actually, I don't have as much money to spend?
Yeah, I think that's exactly right. You think about the things that move first when interest rates rise. We obviously saw that in Canada with respect to housing, 20% correction in house prices, since the Bank of Canada started raising rates. Now, who's impacted by that? Who's really feeling the impact of that? You think about people on variable rate mortgages that might see their monthly payments increase every month, or let's say you had a mortgage 5 years ago and you got a reset. Not everyone resets. There's some people that bought a couple of years ago and they're going to reset in 2025. And they're not going to feel the impact of higher interest rates. And so they're not going to have to make that decision, say, as a family, that I need to cut back because we're going to have to pay more money in interest costs. And so if not everyone does it, it's going to take longer and longer for that true interest rate impact to hit. When we go back into history and we say, Bank of Canada raises rates, when does it show up in the economy? When does it show up in the unemployment rate? It can take a year. It can take 2 years for that to show up. So we're a little bit past a year right now. This is why most people are saying 2023 looks like you're not going to get recession, even though when Bank of Canada started raising rates, everyone was calling for recession.
Yeah.
Now people are realizing that, oh, you know what? Things do take time. And so it looks like it's more of a 2024 story for the economy really starting to slow than it is this year right now.
So in 2024, or just even the balance of 23, what do you see for the labor market and what do you see for the Canadian real estate market?
Yeah, so the labor market right now has benefited tremendously from the fact that we've had a huge amount of immigration into Canada.
Yep.
We have gone from a time period where typically in a month we get about 20,000 job gains. That has doubled over the last year due to the fact that we've had so much immigration. And it's coming at a good time because we know that there's a lot of jobs available. If you look at Indeed, all those job posting sites, there's a ton of jobs available. So we've been able to bring people in, take the jobs that are on offer. That's great for unemployment, or for employment in general in Canada. It's also spurring spending, right? And so you think about, when does that start to unwind? We've had the big surge in immigration, but you look at some of the intentions of immigration policy, and it doesn't look like it's going to slow much. So this is why that soft landing kind of comes into play right now, right? Because when are we actually going to have the factors that are going to slow the overall economy? Well,
I guess the other thing, too, is, immigration, when people are coming in and taking the jobs, there's jobs to be taken.
Yeah.
You start to hear more in the States, and it's, you hear about it more in the States, I think, in terms of the tens of thousands of layoffs in the tech companies. When do you think we're going to start seeing more of that in Canada? Or will we? Maybe this...
Well, it's the interesting thing about that is, you mentioned social media earlier, and every time you read news headlines, you hear about layoffs. But every time I look at the employment data in the U.S., we get more and more job gains.
Fascinating.
So all of the job losses that we're hearing are being offset by other companies hiring. You don't hear in the news of a company hiring 10,000 employees. That's not making news headlines. You hear about Amazon or whoever tech company laying off 100 employees or 1,000 employees. And so we're not getting that sort of thing. And people are getting a little bit misconstrued based on everything that's going on out there and everything they're reading. The economy, and we keep telling us, same thing in Canada, same thing in the United States, things are better than what you're reading. They're better than what you're expecting.
It's fascinating. James, thanks for coming in.
Yeah, thank you.
James Orlando, senior economist at TD. All right, still ahead, immigration is helping to fuel Canada's economy, but did you know second-generation Canadians can make an even bigger contribution? A new report from TD Economics sheds light on some of the benefits, and later, the race is on for companies trying to dominate the AI space. Is there a way investors can ride the AI wave? You're watching Money Talk. We're going to be delving into that as well. Don't go anywhere.